Welcome back to the next intermediate video. We're going to be talking about one of the most important lessons in intermediate, liquidity. Liquidity is going to be covered a lot in a lot of our sessions and our live sessions. Liquidity is something that you must be familiar with as you advance further in the trading industry. Liquidity is being able to move from assets to cash, cold hard cash, very easily. Liquidity is also money. Liquidity is simply money. It is simply the term that we use for identifying where a large amount of orders are. And we also use liquidity to identify, where we believe the market could potentially go to sweep liquidity. Liquidity is built up stop losses. It's built up orders, pending orders. There's liquidity all over the place. And if you can grasp this lesson on liquidity, you should be moving along very nicely in your understanding of the financial markets. So let's dig in deeper into liquidity. Liquidity. All right. Let's pull this out too a little bit here. All right. So liquidity is the ease with which a currency pair can be bought or sold without significantly impacting its price. It is a critical aspect of the financial markets as it directly affects the efficiency and stability of trading. High liquidity means that there are many buyers and sellers actively participating in the market, resulting in narrow bid and ask spreads and smooth execution of trades. In liquid markets, large transactions can be completed without causing substantial price fluctuations. You'll notice that from 5 to 6 p.m. Eastern Standard Time, the market has a large spread. Not only is the market not really active during this time, but there is very, very low liquidity. So high liquidity is always going to be around New York session, London session, and any time during really active trading hours. Low liquidity indicates that there are fewer participants and trading activity, leading to wider bid and ask spreads and potentially greater price volatility. It may be more challenging to execute large orders without impacting the market price significantly. What is liquidity influenced by? So why would a bank or an institution or an investor go from cash to the markets? If they had DXY, if they had dollars, the Benjamins, and they wanted to take their Benjamins and put it into, let's say, Euro USD and buy some euros, that is going to be liquidity going into the market. And this is influenced by trading volume, the time of day, economic events, geopolitical developments, and market sentiment. Major currency pairs such as Euro USD, USD JPY, GBP USD, and USD CHF tend to have higher liquidity compared to exotic currency pairs, which involve less traded currencies. It's important to note that during times of extreme market volatility or economic events, even typically liquid markets can experience temporary drops in liquidity. So right before 8:30 news, or even 5 or 6 hours before news releases, and investors then make decisions, or the banks manipulate price, there's not a lot of people trading. There's not a lot of cash being converted into assets. And this is low liquid markets, right? Now, once there's liquid in the market, once there's liquidity everywhere, it then becomes volume. And volume is then seen in databases, on technical indicators. Hedge funds are able to see how many sellers and buyers there are in a market. Algorithms, artificial intelligence. There's so many different things that you cannot possibly think of that is analyzing the market at a given moment of time. And so, how do institutions liquidate traders? This was one of the main reasons that I lost, was because I was trying to go for the home run. I'd be trading during CPI and NFP, and I'd be trading during FOMC, and I'd be trying to hit the home run. And there'd be low liquidity, and then 8:30 hits, news releases, and the market just goes boom, and the banks take over, the institutions take over, the algorithm takes over, the people with money take over, right? And all us little traders with our table scraps, even the people that make $30,000 table scraps to these big banks and companies. So during economic news and major events, there's volatile moves that don't happen in a typical trading session. And for every buyer, there is a seller. And for every seller, there's a buyer. And so at certain price levels, traders set protections. These are called stop losses, right? And we know about stop losses. These become targets for banks and institutions. This is something beginner traders do not learn until much later down the line in their trading. This very concept right here, that when you place a stop loss, you become a target for the bank, for the institutions, for the smart money. We call it smart money, SMC. You'll probably even learn about ICT, which is inner circle market traders. All these people, man, they come up with these phenomenal trading ideas and concepts, and one of them is just liquidity. So let's go over an example of what this is, right? I love Euro USD, right? And we're going to actually go to the chart and look at Euro USD here in a moment. So imagine that you're in a short position on Euro USD, and you're in a short position. There's a large resistance, whatever. You're in a short. You're shorting the market, and you're up. You're shorting right here, and you're up a little bit. See how price is. I wish I could draw on it. See how price, just follow my cursor. See how price hit here and then is in profit here. You're halfway to TP, and then boom, news hits, right? 8:30 news hits the markets. Look at that wick right there. Anybody with their stop losses in this general area, they get taken out. They get taken out. Maybe you moved your SL to break even, you still get taken out, and then the trade goes in the right direction. Any sellers who move SL to break even or entered lower got swept by this candle. You're gonna hear me say this a lot on these calls. This is why this is a very important topic. Liquidity sweeps. This was a low time frame liquidity sweep on the 15-minute. This candle right here was a liquidity sweep. This candle right here was liquidity sweep. This candle here was liquidity sweep. This candle here was liquidity sweep. This candle, and going further into it, right? This candle right here was liquidity sweep, because that is how the market moves. So before I get ahead of myself, right, you get the idea. You're shorting the market, news hits, large wick that doesn't normally, should not happen, takes you out of the trade, and then goes in the desired direction. Same chart, now looking at the buy perspective. Anybody, any traders, any investors who are trading like we do, who are going long, who are buying Euro USD right here, anybody who's buying at this level, see how it trends upward, and then literally 15, 30, 45, 60. I mean, literally in an hour and 30 minutes, the market went all the way down and wicked any buyers who had stop losses along here or at this one particular level. So anybody in the gray box just got liquidated on this one move right here. To understand liquidity is to understand everything. This is almost more important than support and resistance. Understanding these large wicks, these large quick moves do not happen by accident. They do not happen because traders are shorting the market or buying the market. This is happening because you are setting your stop loss and you are getting targeted. If you take profit, you don't get targeted. If you don't enter a trade, you don't get targeted. If you have a stop loss that is open, other people do too. You are now a number in a volume indicator. To the banks, they don't care. They don't care about your emotions. They don't care about you wanting to win your trade or complete your compound plan or retire your mom or your dad or go buy a boat or a Lamborghini. They just simply do not care about that at all. So I made my point. The reason only 5% of people succeed at trading is the following bullet point. Price, and before I go further, I did not make this up myself. I got this from another individual that I look up to, longtime trader, very, very, very intelligent person, keeps it real, keeps it super real, and highly admire this person. I don't know if he came up with it. I don't think he did. But this right here, this bullet point right here, price moves from liquidity to liquidity, from liquidity to imbalance, from imbalance to liquidity, from imbalance to imbalance. Wow. 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 So let's hit the chart. Let's hit the motherfucking chart, dog. All right. So 1 hour time frame. You already know the vibes, right? 1 hour time frame. Let's look. Let's look at some price. All right. Let's see who's losing. Let's see who's losing money. I made money today. I actually went long here today. I don't know when you're watching this video. It's Euro USD is probably going to be long past this level here. But I went long today on Euro. This was my position, guys. I went from here to here. This was literally my position today. This was my entry. Okay. I caught this move at 8 o'clock today. This move right here. And I got out of the market right there. I got out at these highs right here. So today, let's just look. Let's just look at the smaller time frame before we move on to the bigger time frame stuff, right? Woo! So, and then keep in mind the time of day, the time when we are trading these markets and when these moves occur, because this is very important stuff, guys. London session begins at 2 to 3 in the morning, right? Anybody who's shorting London has shorted here, and the market is moving in their favor, okay? Let's say their target is here. Look at this. The market is moving in their direction. It gets halfway to take profit, and it comes back up. Now, remember, these are 1 hour candles. So here is 4 a.m., right? People are, boom, they're in profit. What are they doing? They're moving their stop losses further up. So this red line, this red box is going to decrease. More and more stop losses are being placed at these levels throughout the session, throughout London session, okay? 8 a.m. hits. 8 o'clock hits. So that means what? Some form of news, because there's just news almost every day now. Look at the wick. Liquidated. Liquidated. You know how much money just in that small move? You know how much money that is right there? 9 pips. Talking like $20 billion in that one candle right there. Fuck. I don't even know. But we're talking 20 bill right there on that one candle. Okay. And then the market goes to TP. How would that make you feel? You're trading London session, you're in a short position, you're up 30 pips, you know, you're up $1,000 on a 1-0. You know what I'm saying? Like I'm sorry, you're up $300 on a 1.0 right now. And then you just lose. It feels so bad. It doesn't feel good at all. Oh, it's the worst feeling in the world. Honest to God, it just is. It's awful. It's terrible. Let's look at today. Let's look at today, right? So boom, 8 a.m. hits. This is what that was the session on Wednesday. Literally just trash session, right? Boom, London session again, right? Look at this. London session again. So check this out. I was in a long position here. I'm going to get rid of that real quick, right? London traders are still shorting. How do I know this? Because after they got wicked out here, they're like, this not happened to me again. We're going to sell. We're going to sell at the previous area of supply and demand. So let me pull out my box. Boom. Got my rectangle. Got my short position. Boom. We in there. Look at that. Boom. Perfect. Going for 40 pips. Anybody shorting at this level, people are selling here, guys. People are placing sell orders right here at 3 in the morning. People are selling the market right here for God knows why. And the market just obliterates them. You know what's even crazier too? Is this wick right here. This wick right here took out this wick right here. Because there was still leftover selling. There was still leftover orders from that wick that got taken out on this wick. Unbelievable. All right, let's continue. Let's continue a little bit more. All right. And then we'll be done. We'll move on. Okay. Okay, let's look here. Now, remember, this right here, this is how the markets move, guys. This stuff right here is how the markets move. The markets move with news. News moves the markets. This is like 120 pips, 165 pips in 1, 2, 3, 4, 5 hours. 125, 165 pips in 5 hours. Okay. Yeah, okay. So let's look before that, because obviously anybody selling any short positions here got clearly taken out with this one candle. We know, okay, clear, okay, understood, right? Understood. But let's look on the smaller time frame. Remember, we're day traders. We trade on the smaller time frames, guys. So 8 a.m. It's 8 a.m. New York session on Tuesday. Okay. Market buys up. So there's what? There's buyers. There's buyers in the market right here, guys. There are people buying the market right here, guys. They see that their position goes higher. Okay. People are in a buy position at this 106,642 level, right? Trades higher. Okay. Look at that. New York traders move their SL to break even. and at 4 a.m. it hits their stop loss or it hits their break even and they don't make any money. And then the trade goes in their direction. Liquidity. 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 That's all I can say. Liquidity. This is liquidity. This is liquidity. Like look and please book a one-on-one mentorship. I will go over this for hours with you just so I can show you how precise the market is liquidating positions to the T. To the T. Liquidating every buyer possible. Everywhere. Any time frame, anywhere, any place. People are losing money, guys. Losing money. All of these moves, liquidating. I don't want to keep it longer. I want to keep going, but I cannot keep the video longer. There's so many examples of liquidation and manipulation so easily. I mean, guys, look at that. That is liquidation. There are so many people buying right here, guys. And it gets taken out in one move. It just happens so much. It happens all over the place. It happens everywhere. Everywhere you can see it is happening. That is why you do not get greedy. That is why you don't let your emotions take over, because you get greedy and then you lose and then you just can't do it. Man, one of my favorite topics, liquidity. I hope you guys took a lot from this lesson. I hope you enjoyed it as much as I enjoyed showing you and sharing with you the knowledge that I have to give. Book a one-on-one. Let's talk about more liquidity. Guys, this is one of my favorite topics, and we're going to continue talking about it in all of the classes and all of the lessons and all the webinars, you know, the virtual calls, whatever you want to call it. We are going to continue going over this concept, study it, practice it, look over it, and let's get this money. I'll see you all in the next one. Take care.